If you're 55 or older and living in Canada, the choices you make about your government pensions right now could shape your financial future for decades. Whether you're planning to stop working soon or just trying to get ahead, understanding your pension options is more important now than ever. Let's dive in. Understanding the Canada Pension Plan, CPP. The Canada Pension Plan is one of the two major government-run retirement income programs available to Canadians. It is designed to replace a portion of your earnings from employment during retirement. If you've worked in Canada and contributed to the CPP through payroll deductions, you will qualify for benefits. The amount you receive is based on how much you contributed, how long you contributed, and the age at which you start receiving payments. The standard age to start CPP is 65, but you can begin as early as age 60 or delay until age 70. Starting earlier will reduce your monthly payments while delaying will increase them. The maximum amount changes annually, so it's important to check the current figures before making your decision. Many people don't realize that CPP is not automatically paid out when you reach a certain age. You have to apply. Applying at the right time is critical, as your choice can affect your financial stability in retirement. Another factor to keep in mind is the CPP post-retirement benefit, which allows you to continue contributing to CPP if you keep working after you start receiving it. This can boost your retirement income later on. Old Age Security, OAS. Old Age Security is different from CPP in that you don't have to pay into it directly. Instead, it is funded by general tax revenues. OAS is available to most Canadians over 65 who have lived in the country for at least 10 years since turning 18. To get the full OAS pension, you generally need 40 years of residency in Canada. Those with less residency can receive a partial pension. OAS is also indexed to inflation, meaning payments increase with the cost of living, which helps protect retirees from losing purchasing power. The age to start OAS is normally 65, but you can choose to delay it up to age 70. For every month you delay, your payments increase by a small percentage, which can be beneficial if you expect to live longer or if you are still earning income and want to avoid higher taxes in your early retirement years. On the other hand, taking OAS earlier might make sense if you need the money immediately or have health concerns that may limit your lifespan. The Guaranteed Income Supplement, GIS. For lower-income seniors, the Guaranteed Income Supplement provides additional support on top of OAS. GIS is a monthly benefit that you do not have to pay back, but it is income tested, meaning the amount you receive depends on your income level. If you are married or living with a common law partner, your combined income is taken into account. GIS can be a lifeline for seniors who rely primarily on government pensions, but it requires you to file your taxes every year to remain eligible. Even if you have no income to report, filing ensures you continue to receive benefits. GIS is not available outside Canada for more than 6 months, so if you plan to retire abroad, you will lose eligibility. It's essential to factor this in if you're considering moving to another country after retirement. How pension payments are taxed. Both CPP and OAS are considered taxable income, meaning you'll need to include them on your tax return. GIS, however, is not taxable, though it is reduced as your taxable income rises. For some retirees, starting CPP or OAS too early can push them into a higher tax bracket or reduce their GIS eligibility. Planning your withdrawals strategically can help you keep more money in your pocket. You may also want to split pension income with a spouse or partner to reduce your overall household tax burden. There's the OAS clawback, officially called the OAS recovery tax. This applies if your income exceeds a certain threshold, which is adjusted annually. For every dollar over the limit, you must repay part of your OAS. This can come as a surprise to retirees with higher incomes, so keeping an eye on your taxable income is essential to avoid unnecessary repayments. Coordinating with workplace pensions and savings. Many Canadians have additional income from workplace pensions, RRSPs, or TFSAS. How these interact with government pensions can affect your retirement strategy. For example, Drawing down RRSPs before taking CPP or OAS can sometimes minimize your lifetime tax bill and reduce the risk of triggering the OAS clawback. On the other hand, if you have a strong workplace pension, you might choose to delay government benefits to maximize the amounts you receive later. When you combine income from multiple sources, it's wise to create a projection of your annual retirement income. This can help you see how starting CPP or OAS at different ages will impact your finances. Many financial planners recommend using government benefits as a base income, then supplementing with personal savings to cover lifestyle expenses and unexpected costs. Deciding when to start benefits. Choosing when to start CPP or OAS is one of the most important retirement decisions you'll make. Starting early can be beneficial if you retire before 65 and need the extra income right away. It can also be wise if you have health concerns or a shorter life expectancy. However, the trade-off is smaller monthly payments for life. Delaying can significantly increase your monthly pension amounts. If you have other income sources or plan to work part-time into your late 60s, this can be an effective strategy. The break-even point, when the total amount received from delaying overtakes the total amount from starting earlier, varies depending on your age, health, and investment returns. Running the numbers for your personal situation can help you make an informed choice. Survivor and disability benefits. CPP also provides benefits beyond retirement income. The CPP disability benefit offers support for contributors who become severely disabled and unable to work. This can be vital for people who face unexpected health challenges before reaching retirement age. In addition, CPP provides survivor benefits to a deceased contributor's spouse or common law partner, as well as dependent children. Understanding these benefits is important for estate and family planning. OAS does not have an equivalent survivor benefit, but your spouse or partner might qualify for the allowance or allowance for the survivor, which offers financial assistance to lower-income individuals aged 60 to 64 until they become eligible for OAS themselves. If this video helped you feel more prepared, make sure to hit the like button and subscribe for more straightforward advice on Canadian retirement, finance, and benefits.